In 2014, Steve Ballmer wrote a check for $2 billion to buy the Los Angeles Clippers. Wall Street laughed. Forbes had the team valued at $575 million. Analysts called it ego spending, a rich guy overpaying for a toy. But here's what they didn't understand. Ballmer wasn't just buying a basketball team. He was buying a tax shield. Because while the Clippers were printing money, selling out games, cashing TV checks, inking sponsorship deals, Steve Ballmer was reporting $700 million in losses to the IRS. He wasn't lying. He wasn't cheating. He was using a legal accounting weapon that's been hidden in the tax code for 80 years. It's called the Roster Depreciation Allowance. And today, I'm going to take you inside the ledger and show you exactly how billionaires turn profitable sports teams into tax-free piggy banks. Alright, let's start with what you think you know. When an NBA owner tells you their team lost money, your brain pictures empty seats, bad merch sales, a franchise bleeding cash. But that's not what's happening, not even close. See, there are two sets of books in professional sports. There's the real money, what actually hits the bank account, and then there's the tax story, what the owner tells the IRS. And these two numbers, they don't have to match. Here's why. In a normal business, you depreciate assets. You buy a $100,000 printing press, and because that machine wears down over time, the IRS lets you deduct a piece of that cost every year. It's called depreciation, basic accounting. But here's where it gets weird. How do you depreciate a human being? Usually, you can't. But in the eyes of the IRS, a professional sports team isn't a collection of athletes. It's a collection of intangible assets. TV rights, luxury suite contracts, trademark value, and yes, player contracts themselves. The athletes aren't employees, they're inventory, depreciable property, line items on a balance sheet. And that distinction, that's where the magic happens. This whole scheme started with one man, Bill Veeck, 1946. Veeck was a baseball showman, owned the Cleveland Indians, the St. Louis Browns, the White Sox. But his real genius wasn't on the field, it was in the tax code. Veeck walked into the IRS with a radical argument. Athletes, he said, are just like machines. They wear down, they get injured, they lose value over time. So why can't I depreciate them? And the IRS said okay. They created what became known as the 50/5 rule. 50% of a team's purchase price could be attributed to player contracts and written off over 5 years. This was the moment the sports tax haven was born. But here's the part that should make your jaw drop. Owners could now double dip. They could deduct player salaries as a normal business expense, the cost of running the team, and they could also amortize the value of those same player contracts as a depreciating asset. Two deductions, same players, exposed to the IRS, but completely legal. For decades, this was the golden ticket, but in 2004, the game changed forever. October 22nd, 2004, President Bush signs the American Jobs Creation Act into law. 244 pages of corporate tax reform, and buried on page 118 was a gift to billionaires. IRC Section 197. This one provision rewrote the playbook. Under the old rules, owners could depreciate 50% of a team's value. That was the Veeck standard. Under Section 197, they can now amortize nearly 100% of the purchase price. Let me show you what this looks like in practice. You buy an NBA team for $3 billion. Under Section 197, you allocate that entire purchase price to intangible assets. Player contracts, broadcast rights, franchise value. Then you write it off, straight line, over 15 years. That's a $200 million tax deduction every single year for a decade and a half. It doesn't matter if the team is profitable. It doesn't matter if you're selling out every game, cashing 9-figure TV checks, printing money on jersey sales. On paper, you're losing money. And that loss, it doesn't just stay inside the team. It flows through to the owner's personal return. It offsets their other income, the dividends from their tech company, the capital gains from the real estate, their entire portfolio. The team becomes a shield, a $200 million a year shield against the IRS. Alright, let's run the actual numbers, because this is where it stops being theory and starts becoming obscene. So here's your typical NBA franchise. $400 million in revenue, $300 million in operating costs, player salaries, arena expenses, staff. You've got a real profit of $100 million, cash in the bank, money that actually exists. Now watch what happens on the tax return. That $200 million amortization deduction drops in. Suddenly, your $100 million profit is a $100 million loss. You pay zero taxes on the team's income. But it gets worse. you've still got $100 million in unused losses. That phantom loss, it doesn't disappear. It flows through to the owner's personal return. It wipes out taxes on their stock sales, their dividends, and their other businesses. The team isn't just tax-free, it's a tax generator, a machine that creates deductions out of thin air and funnels them straight into the owner's pocket. This is why sports team valuations have gone nuclear. The Phoenix Suns sold for $4 billion in 2023. The Commanders, $6 billion. These aren't ego purchases. Billionaires are buying tax insurance policies, and every year they own the team, the policy pays out. For years, this was the perfect crime, entirely legal and rarely audited. But in 2024, the IRS finally stood up. Leveraging billions in new funding from the Inflation Reduction Act, the IRS announced a massive specialized enforcement campaign. Their target? Sports industry partnerships. They aren't just looking for mistakes. They're looking for abusive basis shifting. The IRS is now using AI-driven models to flag partnerships that report massive paper losses despite having billions in valuation. They've even created a dedicated pass-through entity unit, specifically to dismantle the complex webs of LLCs that billionaires like Ballmer and Steve Cohen use to shield their wealth. IRS Commissioner Danny Werliff recently stated that these shell games are coming to an end. But as a CPA, I'll tell you the truth. The law, Section 197, is still on the books. The IRS can audit the compliance, but they can't change the code without Congress. This isn't a crackdown on the loophole itself. It's a war over who gets to use it. Here's the thing. The system isn't broken. It was built this way. Section 197 wasn't an accident. It wasn't a loophole that slipped through. It was lobbied for, written by lawyers, and signed into law with full knowledge of what it would do. And the people who benefit, they'll tell you their teams lose money. They'll cry poor to cities when they won a new stadium. They'll demand public subsidies while sitting on billion-dollar tax shields. Think about that for a second. A billionaire buys a team. That team generates hundreds of millions in real profit. But because of Section 197, they report a loss. And then they walk into City Hall and say, "We can't afford a new stadium. We need taxpayer money." Meanwhile, a teacher in that same city pays a higher effective tax rate than the guy who owns the team. A nurse, a firefighter, a small business owner grinding out 60-hour weeks. They're subsidizing billionaires. Twice. Once through the tax code, and again through their city budget. This is what I mean by the dark capital. It's not illegal. It's not fraud. It's the architecture of American wealth. Designed in boardrooms, approved by Congress, and invisible to everyone who doesn't know where to look. Remember when everyone laughed at Steve Ballmer for overpaying? He's not laughing, he's calculating. Because that $2 billion overpayment is generated over $1 billion in tax deductions. The Clippers are now worth $5 billion, and Ballmer's effective cost of ownership, after the tax shield, exposed on paper for a fraction of what he paid. That's the game. Now you know the truth. And if you want to understand how the 1% actually moves money, not the headlines, not the PR spin, but the forensics reality, you're in the right place. Next time, we're dissecting the Shohei Ohtani contract. The Dodgers didn't just sign a player, they engineered a tax shelter. Subscribe to Dark Capital so you don't miss that audit. If this video helped you see through the ledger, if you finally understand why billionaires are fighting over sports teams, hit that like button. It tells the algorithm this is where the real money talk happens. We'll see you in the next one.